Good morning, traders. Today is March 11th. This is Brad Matheny. It is early Saturday morning. Wanted to give you a little update regarding what's going on. This is the MENT Rotational Modeling and Real Estate video for this week. Remember, please come visit ment.com. Check out what I do. I'm trying to help you learn to become a better trader. Remember that there's really three things that I am trying to do for you. Is help you better understand where opportunities exist in the market. Number two, teach you how to protect capital. And then number three, teach you how to trade efficiently in swing trading and broader market trends when opportunity exists for profits. That is how you live through and sustain your wealth through broad market cycles up and down. The goal here is not to teach you how to day trade, although I am kind of moving in that direction with some requests from clients. But I'm really trying to just keep you on a broad level scope of what the markets are doing and how the markets are going to react going forward. So my expert growth membership is very inexpensive comparatively. It includes a number of different products: my MENT Rotational Modeling System, my custom research, my MENT Live Trades, my detailed research every week. It includes a ton of information for you to be able to learn and grow and explore content. So, for example, if we come into the second page here, really it boils down to this. Trade only when opportunity exists for profit. Protect capital at all times. Learn the mechanics of intermarket dynamics with my custom indexes and proprietary algos, and explore advanced, fully automated growth and trading strategies. The intent here is to help you stay away from excessive risks. Now, let's get into the content here. First thing we're going to talk about is orderly or disorderly. At this point, the new banking crisis, the Silicon Valley Bank collapse, really comes down to a concept of orderly or disorderly. Is the banking crisis that is unfolding going to become a catalyst for other events? For example, Wells Fargo having issues? Could it trickle out into Silicon Valley and beyond? Could it affect broader industry? With a collapse, it could last 4 to 6 months as the feds unwind the bank and or try to find a buyer. More than likely, they're going to try to find a buyer to come in and take over the assets and absorb the debt, kind of like what happened in 2008, 2009. But this may be the start of a broader context. And this is what I talked about for 6 or 7 months now, at least, that the unwinding of excesses is going to affect corporations, governments, global. I was expecting global financial institutions to be essentially in this scenario. The increased debt, or let's call it interest rates, have presented a very unique unwinding of the cheap, easy money policy that prevailed for the past 6-7 years. This is putting a lot of pressure on financial institutions, corporations, city and state governments, U.S. and global, to unwind these excesses of cheap, easy policy. And if they were not properly prepared, they are going to experience some severe drawdowns as this extended unwinding takes place. The Fed may be pushed to become very creative here to resolve the issue while trying to maintain a disinflationary policy. But the real question here is orderly or disorderly. My bet is it's going to be more orderly than disorderly. And because of that, I think we're going to see some real opportunities setting up over the next 48 or so trading days. Roughly 2-3 months, I think we're going to see some real opportunities set up. As my analysis has been pointing, I believe June and July are going to be tremendous opportunities for traders. Okay, let's come back over here to the MENT Rotational Modeling System status. As of yesterday, We had a net short position. Remember, we went short on February 24th with a daily rotational trigger. I'm going to show it to you. This is a downward cycle trend. We are in a downward cycle right now. We should be protecting capital. We are short 50% of our capital, cash 50% of our capital. Remember, this is in our investment account. So hypothetically, if you had $1 million in total assets, you would have 90% of that $1 million in an investment account. Roughly 900,000 would be short 50% allocation. So $450,000 short the SPY and $450,000 sitting in cash. With regards to your trading account, the remaining $100,000 of your million, you would have essentially either broken down into these structures here. Primary allocation levels are 25% in stocks, 50% in cash, 25% in metals as a hedge. This means you'd have $25,000 available to trade, $50,000 sitting in cash, and $25,000 in metals or metals miners mix. If you cannot get into metals with your retirement or your trading account, then you would essentially be $25,000 is a trading allocation and $75,000 or 75% into cash. No bonds yet. Bonds will eventually start to perform, and we'll start to look for bonds as a hedging instrument. Now, when you're in cash, you can move to short-term government bonds. They're now paying 4 or 5%. You can move your metals or your cash position into short-term, bonds or CDs or anything that will provide a 4.5 to 5% return over a short period of time. That's acceptable. Just don't tie it up in anything super long-term right now. Okay, I've added some new symbols here. I've added the U.S. financial system, XLF. I've added the retail sector, XRT, and I've added the U.S. real estate, XLRE. You can see these are all bearish. And again, we've seen the entire daily side move back to bearish. Weekly is still kind of mixed. We have some upward trending. Gold is really starting to push higher. Consumer staples is still bullish, holding up. ES is still bullish. MC is still bullish. Trend is still bullish. And SPY is still bullish on the weekly long-term rotational modeling system. And then here's the results of the modeling system. This will update as we get new data. I updated it as of the end of February. So we're only about 10 days into March. It's probably going to start moving up towards new highs as we are now short and the market is moving downward. So let's go back over to the beginning here. And then I want to show you where we're at here. So this is the ES. Let's go to the SPY. And I'm giving you kind of a broader look here as the SPY. This is a 10-minute chart showing you what was actually taking place over the last couple days. This is a daily chart. And what I want to focus everyone on is the extended downturn that's taken place here from this peak down to these lows. We're back down into kind of a critical support zone with this unwinding of the banking scenario. This could resolve into deeper downside trending. You need to be aware that, this could still unwind as we figure out what the fallout is. Overall, though, ladies and gentlemen, we're still in an uptrend. We still have an uptrend in place. You can see that we need to get down below these lows back over here, the 374 level, to be able to establish any new real unique low. Actually, this is our unique low back down here. We have an intermediate downtrend taking place based on Fibonacci price theory. And we would need to get back above 410 to confirm our upward trending. I expected March to be fairly strong. I still kind of believe that's going to be the case with regards to earnings. General earnings, I believe we're going to see this be an isolated banking incident. And I believe we could see a resolution to this fairly quickly come out of the markets, maybe over the next week or two, and we could see some sort of a big reversion back up to 405, 408, maybe above 410. I don't believe the Silicon Valley Bank issue is systemic. I believe this is a scenario of a failed hedging instrument related to the bank protecting its assets, and it just got trapped in a ugly situation, which again could happen to a number of banks and financial institutions if they're not prepared. So we will pay attention to this as we move forward. Okay, the MENT rotational modeling. Oh, let me point out one quick thing here. This is the gold divided by the SPY. And you can see this is a weekly chart. We're seeing very strong upward trending. And you can see this here. This is a daily chart. This is very strong upward trending. And what's happening here with gold, obviously the collapse of the SPY and the rise in gold. But this type of a move typically correlates to some sort of capitulation. Hypothetically, this is the COVID crisis here. And you can see this rally here is somewhat like a capitulation move, okay? And we are now in that same type of move potentially over here. This type of collapse in the market that we're seeing, the rally in gold, I'm hypothetically calling this a capitulation bottom. I'm looking for a real, unwinding of assets, carrying over, possibly moving the Fed, possibly addressing concerns, a real shift away from hawkish Fed action. So understand that I think we're very close to a capitulation bottom in the market. Now, what that means going forward kind of is open. I think the Fed could come down, a percentage point or so, still keep pressure on the markets, still keep interest rates moderately high, giving some breathing room for the economy, as this banking crisis likely will have some sort of fallout related to the economy. And again, housing looks pretty difficult right now. I am hearing that there are buyers coming back into the market, which is obviously showing up in the data. Let me come over here and show you the data. So the accumulation phase index is still, you show the S&P-Y, or sorry, the SPY up here, SPX, holding up in the positive territory. We're still way off of these lows. We haven't seen extreme selling. You can see here in the monthly accumulation phase index, we're pretty much still trading sideways. As I mentioned to you, we need to see this move downward to see any upward trending. This could be a deeper, moderately deep correction, wave B possibly setting up. We'll see how it plays out. We don't have any real crisis mode yet. The fear index has moved back higher, 8.75. That was going to happen as we started to move into this kind of a downward cycle. You can see the SPY here has moved downward, but it hasn't really collapsed down below these lows or these lows yet. It could, but we need to see how this plays out. And of course, the sentiment index is doing exactly what I expected. Remember, we could have a series of melt ups, kind of like we saw with the SPY right here, little blips. So this type of a blip we're seeing right here could be similar to this or this or this or this, kind of the settling of markets before we get into trending. We could end up in kind of a blip, rotate higher, blip, rotate higher, blip, rotate higher. We need to just see how this plays out. Ideally, an orderly unwinding is more likely than a disorderly unwinding or chaos. Okay, real estate, still up above extremes. We're moving back down in a hostility level. We've seen this before. This is kind of channeling up here in this upper channel. We need to see this kind of break downward if we're going to see the market really move away from these hostile ranges. I did see some data the other day that showed that homeowners owning multiple properties in the U.S. is at the highest level, actually beyond the 2008 levels. So we've got a lot of, investors out there, Airbnbers and what have you, owning multiple properties, which is tying up inventory. I think that, given a broader scope of unwinding, a lot of that inventory will start to hit the market, especially if the Fed's continued tightening, stalls consumer spending quite a bit. So be aware that we've still got quite a bit of unwinding to go here for this to come back into appreciative or opportunistic territory down around this area. Down around this 220, 230, 240, or even below 200 would put us back in opportunistic areas, back over into here. And we're up at 396.52. We have approximately 50%, 45-50% decline to go here to get back into opportunistic territory. Even moving down here into the 260, 270 area would be a 35% decline. Okay, the valuations index chart. This is a great chart to understand where we're at in cycle trends. It is a custom index. It's something you're not going to find very easily. It is inverted, so it moves opposite. It actually goes negative to go up and positive to go down. You can see here that we're bottoming. Like I had mentioned to you, we need to see some real upward basing here, kind of like this or like this. And we are not quite seeing it yet, but we're starting to see early March turn white as an upward candle. That's a pretty good sign that we might be nearing some sort of a capitulation bottom here. We've also been extended to the downside here. We need to see how it plays out. Let's see if March actually does what I expected. Moves higher into April, mid-April, and then starts to top out. We'll see, but ideally, this looks like a very solid unwinding of assets. It's just, I think right now we're kind of at a crisis point where, let's say, extended unwinding processes may be creating a bit of chaos. Okay, we talked about this earlier, the MENT Rotational Modeling System. And remember, this really is the key to everything that I do. This is the key to the investment strategy. And then from here, we manage capital to provide opportunity for trading. So, and this is obviously the reason why it's so important, is because it outperforms the SPY consistently in an up or a down trend. Okay. Next, we have the real estate market. You can see that price reductions have come down. They're still well above 100%. You can see dynamic price modeling here. So this is a real price factor, is still negative. It's at negative 18.93, although it's gone back up last week. Model market demand is up at 28. As I had mentioned to you, we had been up above 140 before. I think this is just a reversion. I think what's happening right now is the market's flattened out, doesn't know what to do. It hasn't really collapsed. It hasn't really gone up. I think that we're seeing some demand in the market, but I think this is a downward pressure, and I think this is just a reversion to a mean. So hypothetically, if you look between 40 and minus 40, a reversion in that area would put us somewhere back near zero. Between 140 and minus 40 on the demand line, which is the yellow line, that would put us somewhere back in the 25 to 40 range as a reversion. We're kind of right back into that reversion area here. Depending on what happens next, we're likely to see some sort of a big trend take place. And you can see the reductions have come down. The active listing counts have come down. The days on markets have started to come down. Pricing has come down quite a bit. I mean, the market is just not very opportunistic right now, but there are still people out there buying. Okay, United price trends have kind of flatlined. Price reduction activity has reached a new high, 150%. Active listing counts come back down. This is fairly standard. You can see this rotation. I believe this is related to the number of homes that re-enter the market or waves of foreclosures that hit. New listing count metrics are starting to tank a little bit, showing us that we're not getting a bunch of new listings in the market. And of course, we have our heat rank, which has kind of stayed in this moderate negative territory for the past couple of weeks. The tightness rank has collapsed over the past couple of weeks. Inventory strength is continuing to weaken. This is telling you that prices will continue to decline, in my opinion. And of course, we had some big blips in seller desperation over the past couple of weeks, back in January and just last 2 weeks ago. Now seller desperation is kind of waning. This is a pop based on the data. This pops depending on whether the data shows that we're seeing large amounts of price declines, and this is all custom modeled. So you can see that we are kind of in a stagnant downward cycle right now. Okay, the custom volatility index has collapsed, just like I mentioned. Once we had gotten up into this mode, kind of as I mentioned to you over here, we can see upward trending continue to move in these kind of blips, as I mentioned earlier. Upward rally, blip, upward rally, blip, upward rally, blip, upward rally, blip, upward rally, blip. And again, this was 2021. Upward rally, blip, upward rally, blip, upward rally, blip. Remember, this was a very strong move, almost 100% in the NASDAQ through this time frame. I believe it was more than 45% in the S&P. Understand that we could be in that same type of an early basing stage. This could be a blip. We haven't gotten down below this 6.0 level, which is where we get into real worry about bearish trend phase. But we do have a downward blip right now, and that's very likely to be resolved over the next couple of weeks with possibly a reversion back up to 10, 11, 12. And that's it for now. So let me come back over here. And I wanted to highlight the Trade Tank SPY. This is the rotational modeling system. And you can see we have gone bearish here. We've got a couple topping patterns here. This is a daily SPY chart. We're now into solid red trending. This is the SPY weekly chart. We're at moderate yellow, which is, getting ready to move into this pinkish trending. We can be in pinkish trending and still be bullish. But this is the weekly trend on the SPY. This is the daily trend on the SPY using the MENT Rotational Modeling System. And what it's telling us right now, ladies and gentlemen, is we've got to be very cautious of some potential chaotic moves in the market. Okay, again, come follow me on my website. Join me in helping you prepare for what's coming next. The next 5 to 6 years are going to be really powerful for traders and investors to be able to make some real money. We're in an unwinding phase that I've been warning you about now for over 2 years. Ever since COVID hit, we saw the big speculative bubble hit. I started warning you that the next 7 to 8 years are going to be really incredible, and we're going to go through an unwinding phase, which is what we are going through right now. And I'm trying to help you navigate this to try to find opportunities. Come join the Expert Growth member page. This is the Expert Growth homepage. Come get all of the research that I provide. Come get all of the resources that I provide. Pay attention to my research. Learn how to protect your capital and learn how to grow your assets using my technology. Thanks again, guys. I'll talk to you soon.